Hello everyone, my name is Mark Armstrong. I'm an account manager here in B4X, and today we're going to talk about technical analysis. Now the videos until now we've described how to trade, how to open and close a position, how to read the charts, but the real question is when to trade, so when to know whether it's a good time to buy or sell. Now there's two types of analysis that we do on the markets when determining whether or not to open a position. And the first type is called fundamental analysis, which is basically what's going on in the news today and how that's influencing the markets. So we can see, of course, on the bottom right of our screen, we can see a video uploaded every morning by our chief analyst, Mr. Robert Petrucci, and he's telling us about the fundamental analysis, what's going on in the markets today, what news to expect, and basically what are the conditions in the market. As well, your account manager should be sending daily market updates with just a brief description of the fundamental analysis for the day. The second type of analysis that we do is called technical analysis, and this is done by looking at the charts and analyzing the familiar price levels, so that we'll be able to know when is it high so that we can sell, or when is it low so that we can buy. Now the first thing when looking at a chart is to notice the trend. First of all, let's make this chart a little bit bigger so that we can see the whole thing. Okay, and there's three possibilities for a trend, and we can say that we have an uptrend, a downward trend, and a sideways trend. Right now we're looking at a sideways trend. We can see that's not really moving seriously up or down. If we move out, we can see that here we have an upward trend for the euro dollar. It's been going up steadily since June over here. So when trading, when understanding the trend, it basically gives us an extra tip, because the trend is your friend. Whatever happens, whatever's been happening in the past is likely to continue happening in the future. And when we place trades, we're basically making a statistical judgment of what's the more likely scenario, and then of course to set a stop loss just in case we're wrong. We also have different trends based on time periods. So if you look at a daily chart, then you can see what's going on overall in the market. But if you look at a 1 minute chart, so that's basically a short-term trend, what's been happening in the last few minutes. And we can see that on the short term, the price has been going down. Or we have a mid-term trend, which can be seen by the 1 hour or the 30-minute chart. We can see that that's been going up for a while. Now, to determine the familiar price levels, we do this simply by drawing a line on the chart, and we'll call them support and resistance lines. Now, a support line comes from the bottom of a chart, and we just draw a line along the bottom just like this. And that gives us a reasonable place. What we're doing when we draw the line is to touch as many points along the bottom of the chart without really going through them. And here I've gone through it a little bit, which is okay because these are of course approximations. So the line on the bottom of the chart is called support, because every time the price goes down that far, there's something supporting it and holding it up from below. And we have a very similar line along the top of the chart with a different name, which is called resistance. And the resistance line is drawn along the top of the chart. As you can see, we try to touch as many points along the chart without breaking through it. And basically it's called a resistance because every time the price gets up that high, there's a resistance pushing it back down. So between the support and the resistance lines, we have a comfortable price range, which is the more likely scenario that the price will always stay within this range. So looking at this chart, we can say that the price is likely to fall, and what we do is we'll simply place a sell order on it, and then we can place our stop loss right outside the range, somewhere over here or over here, So that means that in case we're wrong, we can get out with a very relatively little damage. But if we're correct, we have all the way until down here where we can put our take profit and make some very, very nice lucrative gains. The support lines and resistance lines, like I said, they're always approximated. Every investor, every analyst will draw them a little bit differently, which is why you need to give a little bit of room for error. But what happens is they're not solid lines. It doesn't mean that the price cannot go up from here. It simply means that it's more likely to stay within the range. Now, if some kind of fundamental analysis, some kind of news comes out and it causes the euro to go up against the dollar, and it breaks through this line, especially if it breaks through with momentum, then we can say that it's more likely to continue up until the next resistance point, which where we can see we'd have a resistance point here, a resistance point here, and then a bigger resistance point even here. And that's basically the basics of technical analysis. More to follow, and if you have any questions, always feel free to ask your account manager. We're here to help. Have a great day.